rates over the next year are going to go a fair amount higher, Kelly. I mean, I think there's been some artificial depression of these long-term yields. The Fed, with their policies, are basically sitting on the yield, keeping it down. And if economic momentum stays fairly decent here, not only in the fourth quarter but going into next year, maybe the impact of lag stimulus really starts to come home to roost, if you will, in boosting economic growth, then I think the Fed might have to back away. And if they have to back away, there's quite a bit upside. Just one example on that, commodity prices are certainly up a lot, industrial commodity prices in particular, but now energy as well. But if you look at the embedded inflation expectation in 10-year TIPS right now, Kelly, it's about 1.7%. And the 10-year yield, as Rick just said, is around 77 basis points. Normally, that 10-year yield would trade above the embedded inflation expectation. So there's maybe 1% upside just to kind of get back into normal range again.
Right, and that's kind of the negative 1% real rates people have been talking about. So, Jim, I mean, it's interesting to hear you say that if the Fed had to back away, that things, that people would feel pretty positive about that, the markets would take that well. What if this is another head fake? I mean, we're making a lot over, 10 or 15 basis points. And while we all hope that yields would look more normal, it's hard to accept that we're going to all of a sudden see some sustained breakout here, right?
Well, it certainly could be. Yeah, I agree with you. That's difficult to call. But I do think it's not so much that we're talking about a new secular rise in yields that's going to start. I think there's just a lot of artificial rate setting with the $7-8 trillion Fed balance sheets and balance sheets around the globe. And I really think the economy and what it's doing, Kelly, is looking awful good in terms of the numbers it puts out and the upside momentum here, while we're just continuing to chronically stimulate the heck out of this thing. And if that stimulus comes home to roost, then I do think there's a path where rates could make a stair-step move upward. It wouldn't necessarily be a new secular run, but it could be a pretty big move. And if you consider the amount of portfolios that are still piling into bond funds and out of stock funds, it could put a lot of investors at risk. I think stock market would be fine with it, but I think bond investors could get hurt pretty bad.
Shepard Smith here. Thanks for watching CNBC on YouTube.